that costs more, demand can outgrow supply and paying our cash, leaving less in the cash. Year 12, a perfect example. EPS and ROE help us, but everything else pull back a little bit. Okay, let's get into it. Our strategy that covers a provider. So what does that actually mean? Best cost, not just cheap. We keep price competitive, but back it up with real investment, better material, design, display of both camera and drone. That's how AC got to 5.5 to and a UAV got to 5 to 8. On marketing, we spend more work, not just for show. Hold it that a credit rating the whole time too. Now here's a scorecard. Year 6 through 112 EPS basically flat, still strong at $9.35. ROE climbed it to 47%, but stock price, image, and revenue all slipped it a little from year 11. So financial held up. Marketing softened a little bit. Zooming out, quick timeline, 6 reset, 7 upgrade, 8 warming sign, 9 best year, 10 Skoda, 11 keep growing, 12 put to the test, take away image and product quality need contest attendance, but one-time fix. Let's go year by year quickly. Year 6, growth start. Camera share fell to 18%. Drone carried us that year. Year 7, we improved quality by adding more AC camera. Camera shares climbed. Image jumped from 75 to 82. Year 8, camera share it hit at 25%, but drone lost a little grounded. Mostly marketing issue by region related into the US and Asia, where demand was hit, not as much in Latin America for drone. Year 9, everything clicked. Both products did well. Image hit 87. Year 10, we scaled up 3 camera model to 4. Cash stays strong. Year 11 is our best year. We prove out a lot of UAV products. Revenue hit at $30 million, mostly from drone. Image dipped just a touch. And then year 12, EPS stayed above target. ROE went up. The revenue, stock price, and image all dropped it. Not a failure, more like a stress test. Show us exactly what is fixed next. Image, product, April, and demanded. Year 12 was a dropped year. Years were changed, even ROE were higher, but other things were terrible, lower. Before we pulled it back, a code value fell, and we weak as CSR, focus on growth as EXO. Like here is a before and after. Revenue down a little bit, profit down a little bit. ROE up, stock price down, image down to the 80. Yeah. Bottom line, the story not just growth anymore, it's growth maturity, and now course corrections.
Next, let's move on to product and marketing strategy. Our product and marketing strategy followed a best cost strategy, and the goal was to offer enough products, value to support demand while keeping pricing and marketing spending discipline. And our product strategy focused on improving PQ and model selection. For price, we use value pricing instead of competing only on the lowest price. For place, we balanced retail channels with direct online sales. And for promotions, we use advertising, website support, and sales promotion to to create demand without overspending. And these choices fits our strategy because we wanted customers to see value in our product, and we also wanted to protect margins. For cameras, our marketing strategy had to serve both entry-level and multi-featured buyers. And for entry-level cameras, the focus was accessibility. We used value pricing and controlled promotions so the product stayed competitive without turning the company into a pure, low-price competitor. And for multi-feature cameras, the focus was buyer appeal. We improved PQ, added stronger features, and expanded model selections so that customers had more reason to choose our brand. And both approaches fit the same overall strategy because we were trying to balance affordability with enough product value. And retail access, website support, and advertising can help reach both types of buyers. As you can see on the graphs, AC camera sales grew from 568,000 units in year 6 to 928,000 units in year 12. And UAV drone sales also grew from 178,000 units to 244,000 units. Product PQ also finished higher than the starting point in both product lines. And the full pass still shows that product and marketing choices help build demand over time, and stronger buyer appeal support higher unit volume. For AC cameras, the main story was recovery. The segment started from a weaker position, so we needed to build our buyer appeal. PQ improved from 3.9 to 5.3, and the model count increased from 3 to 4. AC became a much stronger contributor by the end of the simulation. And the recovery comes from pricing and promotions and improving customer value. AC sales stay high, but future growth still need both product appeal and marketing support to stay competitive. For UAV drones, the story was strong growth with channel discipline. UAV became an important revenue engine for the company, and units sold increased. PQ also ended about the starting point, and the number of models increased from 2 to 3. At the same time, we avoided simply spending more everywhere, and the company used channel discipline instead of trying to win every market through unlimited spending. And strong product categories still need efficient distribution and enough buyer appeal. Next, let's move on to product strategy. Our production strategy was about balancing cost, capacity, and product value. Production cost per unit increased over time, especially for UAV drones. But that does not mean strategy failed. Some of the cost increase came from better features, stronger quality, and more advanced products. That fits the best cost strategy, and we were trying to support enough customer value while still keeping costs under control. The lesson is that production costs should be judged together with product competitiveness, not in isolation. By year 12, AC cameras reached high volume with 928,000 units assembled, but AC also had 94.3 thousand overtime units, used all 300 installed workstations, and still need 34 more workstations to avoid overtime. That suggests the AC capacity was under pressure, and UAV drones were different. UAV assemble had 0 overtime and did not need additional workstations, so UAV capacity was properly, while AC became the next operation bottleneck. Capacity decisions should stay selective. AC may need future expansion, but UAV expansion should wait for stronger demand. The production lesson is about how to respond to capacity pressure. Overtime can be useful when demand is uncertain because it avoids locking the company into expensive expansion too early. And that was the logic behind using overtime instead of automatically adding more workstations. But overtime should not become the permanent solution. When overtime keeps appearing, it means the company should consider in-house capacity expansion. But outsourcing was not the main lever for our strategy because we relied mainly on in-house assembly capacity and selective overtime, which fit the best cost approach because it gave us control without overcommitting or unnecessary expansion. Next, let's move on to compensation and labor strategy. Our compensation and labor strategy focused on labor efficiency, not expansion. That was along. With those graphs, UAV labor cost per unit improved over time, which suggests that labor spending was translating into better efficiency. AC was more mixed, AC labor cost remained more pressure, and AC productivity declined over time. That is why we should not judge labor strategy only by whether pay was higher or lower. And the better question is whether labor decisions improved productivity, reliability, and unit economics. Labor spending had to improve efficiency and quality without wasting margin. Labor strategy worked best when spending translation into lower unit costs and stronger productivity. Our pay and training logic was built around operating outcomes. Training and incentives were selectively. UAV received heavier training support because drone production was more complex and productivity mattered more for that product line. And AC was managed more tightly, but year 12 showed that cost control can create pressure if productivity and capacity do not improve enough. So the strategy was not simply to increase compensation. The goal was to make labor spending support productivity and unit cost. Training and incentives only make sense when they produce measurable returns. And for AC cameras, productivity was 2,780 units per PAT, and labor cost was around 34 per unit. That cost improved from year 11, but AC still had overtime pressure. So AC looked better in unit labor costs, but the capacity and the productivity pressure did not fully disappear. For UAV drones, productivity and labor costs improved. UAV had much higher training spending, which supported productivity but still needed to stay tied to output. And labor decisions should protect AC reliability while keeping UAV training connected to measurable performance. Now we move to corporate citizenship strategy. Our strategy treated reputation as a long-term asset. The image rating increased from 75 in year 6 to 98, 89 in year 10. It stayed strong at 87 in year 11 and fell to 80 in year 12. Even with that decline, it still beats the investor target of 77. And CSR supported brand image and customer trust. A stronger reputation helps customers trust the company, but CSR spending needs to stay disciplined. The lesson is that reputation needs consistent support. It cannot only be handled through occasional catch-up spending. The image rating was still above the target, but the drop from 87 to 80 showed that reputation can weaken quickly. CSR actions supported reputation, but they were not enough to fully protect the image rating. So CSR did not fail. The real lesson is consistency. Corporate citizenship should be treated as part of long-term strategy and not just an optional expense. If image weakens, it can affect future relative performance and company's competitive position.
This section describes our finance strategy. Our finance strategy was built to support our best cost strategy. Because our overall strategy focused on strong product value and fair price. Our finance decisions has three goals: protect profitability, keep enough cash for CSR and production, and still return value to shareholders. We kept debt very low on purpose. By year 12, our debt to equity ratio was only 27 to 73. This helped us hold a credit rating for 5 straight years, from year 8 through year 12. These two charts show the result of that strategy over time. It has grew from 292 in year 6 to 935 in year 12. And ROE increased every single year, reaching 47.3%. Our best result in the whole project. Revenue also grew strongly from 415 million up to 830 million in year 11, before pulling back slightly to 688.5 million in year 12. This confirms our finance strategy supported steady long-term growth, even though the last year showed a small correction. This table shows exactly which decisions moved these numbers. We reduced our equity base and directly boosted both EPS and ROE. We also paid off 8 million of long-term debt, protecting our credit rating, and we kept our dividend stable at $2 per share, with a payout ratio around 21%. So our main decisions were buy stock to raise EPS and ROE, pay down debt, and to protect our credit rating, and keep dividends steady to reward shareholders. One more type of decision. We also put cash into corporate citizenship, about 2 million in charitable donations, and 3 million in renewable energy in year 12. Because our finance strategy had to support image and reputation too, not only the stock price. So that's our strategy. Now let's look at the competition. This table shows where we stand against the industry average. Our AC camera and UAV PQ were both below average. Our brand reputation, 87, was well above the 81 average. Company B is the main reason our PQ looks weak. Company B has the highest ratings in the industry and clearly runs a differentiation strategy. Higher price and strong PQ and heavy marketing spend applied consistently across every region and both product lines. This table shows our best regions. Asia Pacific for AC cameras at 24.7% share, and North America for UAV drones, our biggest and most profitable region, at 43.3 million operating profit. In year 11, our close competitor was actually Company D, just 3 points behind us. But Company B fell in year 12, dropping to 76 points, mainly because of stock out. They lose about 21,000 UAV units right here in North America, the exact region on this slide. Due to insufficient production capacity, the single mistake took D out of the real competition. So overall, Company B is our biggest competitor, strong every year, and sports car and spends its money wisely. And the company was very conservative. Too much cash, not enough capacity, and in year 12, they paid the price.
Strategy evolution. I'm going to explain to you how our strategy changed throughout the simulation and what those changes taught us. We remained a best cost provider, but the decisions supporting that strategy became more precise over time. Early on, it was about fixing obvious weaknesses, right? Especially our low AC camera appeal. Later, we had to manage more connected systems involving everything together. What changed over time? In the early years, the strategy was mostly corrective. In year 6, AC camera PQ was very low, and market share was also low, which showed that the price promotions could not overcome a weak product. We improved PQ, expanded the AC line, and from 3 models to 4 models, and recovered share toward the industry average. Marketing also evolved from broad spending toward efficiency, while product production moved from simply using available capacity and making targeted workstations investments. By year 12, the challenge was no longer basic recovery, it was maintaining every advantage at the same time. Strategy became more specific. Our strongest improvement was learning to identify the actual cause of the problem. When AC demand was weak, the main issue was product appeal, not a lack of advertising. Improving PQ created a more durable benefit than repeatedly increasing promotions. We used the same logic in production by adding targeted AC workshops rather than making a broad facility expansion. Year 12 then showed that stronger ROE alone could not offset weaker revenue, image, and stock price. So financial decisions still had to support the operating strategy. We learned that. In conclusion, I'd rate our company's performance as strong, but not amazing. We increased EPS over $6.40, nearly doubled revenue, maintained an A credit rating, and finished with an overall score of 103. We also developed 2 profitable global product lines. Our best year by far was year 11, having our highest revenue, highest EPS, highest stock prices, and highest net profit with a greater rating and solid ending cash balance. However, year 12 showed that the strategy was not complete. Revenue, stock, price, image, PQ, and market share all weakened. Our next priority would be to rebuild product appeal with enhancements and better quality materials, lift our image with more charitable contributions, all while preserving the cost discipline that supported strong margins and ROE. The simulation ultimately taught us that strategy is not one major decision. It is a connected system of product design, marketing, capacity, labor, corporate citizenship, and finance working together. Our lessons learned. Lesson 1, strategy is a system. This is the biggest lesson to us. Our first lesson is that no decision by itself is alone. Everything affects everything else. Adding an AC model improved buyer selection, but it also increased assembly complexity, labor pressure, and capacity needs. Lower pricing supported our value position, but it did not guarantee market share when competitors had stronger PQ or marketing support. Lesson 2, best cost still requires product appeal. Best cost does not mean offering the cheapest possible product. In year 6, our PQ was quite low and our shares were very low. Once PQ moved above 5 stars and we expanded model selection, share recovered to about 25%. In year 12, this repeated lesson came with the UAVs. We increased the line from 2 models to 3, but our PQ fell. And the market share weakened. More variety did not help us, right? Because it dropped a lot of other aspects. Lesson 3, marketing efficiency matters more than spending. Marketing cost per AC camera declined in year 6 to from $47 in year 6 to approximately $30 in year 11 because our marketing became more efficient. We improved product quality from 3.9 stars to 5.5 stars, strengthened the brand, and increased annual AC sales. Because advertising, website support, and retailer support are largely fixed on semi-fixed budgets, those costs were spread across far more units. Lesson 4, capacity decisions need payback discipline. In year 10, avoiding unnecessary capital spending made sense because the remaining payback period was limited. In year 11, adding targeted AC workshops reduced overtime pressure without committing to a major facility expansion. By year 12, however, our AC still produced over 94,000 units through overtime and needed 34 additional workstations to eliminate it. This showed that overtime is useful for temporary demand, so not year to year like we did. But recurring overtime eventually signals a permanent capacity constraint. Lesson 5, labor strategy must be connected to output. Labor spending should be judged by productivity and unit economics, not by compensation alone. Our UAV productivity improved, while our UAV labor cost per unit declined. AC productivity, however, fell as product complexity and more overtime pressure increased. Reducing compensation may lower costs per employee, but it can also reduce productivity, increase and create more overtime. The correct measure is whether wages, incentives, and training improve output, quality, and cost per unit. Lesson 6, financial strategy is a score driver. EPS increased and RE exceeded investor target. However, the stock price still fell in year 11 to year 12. That happened because investors evaluate future momentum as well as current efficiency. The company used capital efficiency, but the market also saw weaker growth and competitive positioning. Finance therefore reinforced product, investment, demand, growth, and reputation. Lesson 7, CSR must be consistent. Corporate citizenship helped raise our image greatly. Charitable giving, renewable energy investments, green initiatives, and responsible supplier practices strengthened our customer trust and brand reputation. But image fell in year 12, and this is because we were not consistent with it. Lesson 8, forecasting must be stress tested. Forecasting is useful, but there are not guarantees because every competitor submits decisions at the same time. A demand projection may change once competitors adjust price, PQ, advertising, or warranties. Year 12 had strong EPS but lower revenue than year 11, proving that financial projections should be tested under multiple scenarios. Stockouts lose profitable sales while demand shortfalls leave capacity unused. A stronger planning process would test optimistic, expected, and conservative demand before making production and spending decisions. What would we do differently? With the do-over, we would invest in product appeal earlier rather than waiting for the market share weakness to become obvious. We would also track UAV channel performance more closely, especially the balance between direct online demand and third-party realtors. Financially, we would establish a target cash range and a consistent image maintenance budget so that neither cash nor reputation became unbalanced. More importantly, we would protect PQ in year 12. Instead of expanding our models, we would have kept the models the same, but expanded product. And here are our graphs. As you can see, we have our financial outcomes. Next. Our revenue and market share. our product value and cost, and our operating outcomes. Thank you.